Let's get more on the economy and today's inflation numbers. Our next guest says the Middle East conflict will exacerbate economic headwinds, making the outlook for the year a bit less favorable. Joining me now is Gregory Daco. He is chief economist at Parthenon. Great to see you, Greg. And, I guess arguably you've seen this stagflationary wind kind of blow through the economy. At least we expect it to have that effect. What does it mean, do you think, we're going to settle out in terms of a growth rate and in terms of an inflation pace?
Well, I think, as your prior guest was saying, we have to be very cautious about the underlying assumptions as to how the Middle East conflict will evolve. But I think it's important to remind everyone that we are in this multidimensional shock environment where it's not just about one particular supply shock, but it's really the confluence of supply shocks, from the trade shock and the tariff shock to the immigration shock to the positive AI shock and now this Middle East conflict that are all affecting the U.S. economy. And if we look out over the rest of the year, we're anticipating U.S. growth to actually decelerate to around 1.5% by year end, which would be a fairly slow pace of growth, with inflation rising towards 4% and ending the year around 3%. So we're going to be in an environment that feels somewhat more stagflationary. It's not outright stagflation, but it is an opening to a potential further downside shock in terms of economic activity.
Yeah, I was going to say 5% plus nominal GDP when, almost 4 percentage points of it is coming from inflation is sort of a less comfortable way to get there than we've become used to. What does that mean for policy, in your view, for the Fed?
Well, I think generally speaking, we've heard from many Fed policymakers that it's prudent to await more information as to how the Middle East conflict will affect economic activity and inflation. The minutes from the March FOMC meeting had a bit of a hawkish tilt to them, with essentially this focus on the fact that inflation remains above the desired 2% target and that there will likely be further inflationary pressure. So I don't think we should expect any type of move from the Fed over the coming months, because we are in this environment where inflation is likely to move in the wrong direction. And most Fed policymakers appear content with what they call a balanced labor market. I would tend to view the downside risks to the labor market as being dominant, but the dominating view right now amongst Fed policymakers is that downside risks to the labor market are not as present as some may believe. So we're likely to see a hold when it comes to the Fed for the foreseeable future.
How would you characterize the fortunes of the consumer right now in aggregate? Because we did see a decent personal spending number. Obviously, people have been talking about the tax refund bump we're getting in the first part of this year. On the other hand, kind of real income growth has been lagging to some degree.
Yeah, you're absolutely right. I mean, the headline numbers this morning in terms of February consumer spending, even adjusted for inflation, were relatively healthy. But make no mistakes, increasingly, we're seeing consumers running on fumes. We're seeing an environment where if you look at real disposable income growth, it's trending around 1%, while consumer spending is trending around 2.5%. That means that consumers are increasingly dipping into their savings, using credit, and using wealth as a means to finance their outlays. Those are not infinite measures to sustain economic activity. And I'll tell you one more thing that I think is quite telling. When it comes to tax refunds, on average, for every family across the U.S., you're going to see tax refunds around $300 per household. In terms of the energy shock that has already occurred from the Middle East conflict, you're going to see a hit of about $350 negative.
Greg, 1 second. Sorry about that. Just stay right there. We are looking at marketing agency Jack Morton ringing the closing bell at Cboe in Chicago. That ends the regular trading day for options. Apologies, Greg. You're just talking about how essentially the energy cost increase is going to offset that tax refund effect.
That's right. We are going to see essentially the energy shock from the oil price increase and gas price increase more than offset the increase in tax refunds from the One Big Beautiful Bill. So we should be very cautious about any significant tailwind coming from these larger tax refunds.
And I guess what is, when you talked about your projections for the year, the 1.5% real and then inflation going higher, what does that bake in terms of where oil prices go from here?
Well, essentially, our baseline case is that we see average oil prices on a Brent measure that slide down to around $85 in the third quarter and then further down towards $80 by year end, which would still be about $15 higher than they were pre-conflict. So that is a baseline assumption. But let's not forget, a couple of days ago, oil prices were trading around $110 per barrel. So there could very well be a downside risk where inflation rises towards 4.5%, maybe 5%, and where growth actually falls below 1% in that type of scenario.
And then I guess you can kind of go a couple of moves down the board on that in terms of yields remaining a little bit elevated, at least relative to where people were hoping they'd be, mortgage rates following, and the housing market getting a little bit stuck in there.
Yeah, that's really the key issue in this environment, is that what we're seeing in terms of interest rates is unusual. Usually when you have a geopolitical conflict, you tend to see downward pressure on long-term yields as there is a safe haven flow into treasuries. That has not occurred this time around. We've seen pricing of fewer rate cuts by the Fed lead to upward pressure on long-term rates. We've seen higher inflation expectations push higher long-term rates. And we've also seen questions around fiscal sustainability and Fed influence pressure long-term rates higher. So the confluence of higher inflation and higher interest rates is going to continue eroding growth momentum and lead to slower growth as we navigate through the rest of 2026.